Hello, everybody. Welcome to this month's edition of DeSimone on Deals, the Exit Strategy Podcast. As you know, I really am passionate about making sure people get the right outcomes and the best outcomes for their exits. And that means introducing my audience to different professionals that can help them better prepare for these exits. And today we have a very special guest. We have Kathy Kelly from Webster Bank. Um, Most of you may not know this, but she is the preeminent expert in SBA lending, probably nationally, but definitely in Massachusetts. If I have a question on SBA, this is who I call. There's a lot of companies that get acquired that the buyer needs an SBA loan to or guarantee on their loan to make this happen. And if that's the case, Kathy's the one that has most of the answers, if not all the answers for you. So let me, I gave a quick overview of Kathy. Kathy, why don't you fill in the blanks of what did I miss?
Well, I've been SBA lending for about 22 years, and I am exclusive to SBA. I'm not doing any conventional, although I did early in my career. And I lend in New England and New York. So up to, 90% financing for business acquisition and majority owner occupied commercial real estate. Those are my two big buckets.
Awesome. So we'll and most likely we're going to talk about both of those. We're going to focus on M&A, but a lot of times there's the other type of lending that you talk about comes into play in these type of acquisitions. So we'll get into that. How many loans do you think you work on a year, underwrite a year?
Well, how many do I work on and close is probably 12 to 15, but I look at a lot of deals, as I'm sure you do. A lot of
Mhm.
stuff that comes and goes, might go elsewhere or just doesn't go anywhere. So I talk to people, and especially in the last 3 years with the aging of the baby boomers, the volume has increased exponentially. So
So
a lot
you
of
you look
conversations.
you look at a lot of deals. You close 12 to 15. What makes a deal get from I'm looking at to actually closing? Like what how do you get through the ooh, I'm a professional. I can knock my microphone over during a podcast. Um, how do you go from just being looked at to actually getting closed? Like, what are the things that you look for to move it along?
Yeah, I mean, well, first of all, that they have to choose us to go with us, right? But it, a lot of things can fall apart during the process, as you know. So normally, once somebody starts, the front end piece, especially if you get in early, you talk about all of the rules and try and keep them SBA eligible. So you don't what I don't want is somebody to get all the way to a purchase and sale and then they find out, oh, it has this language, we can't move forward. So I love talking to them early in the process, and then our turnaround time when I have a package is about 2 weeks. So we can move very quickly, but there can be a long distance between an offer and a purchase and sale. So, and a million things can change in between. But yeah, it's
Cool. What makes someone what when you said to that you want to make sure they're eligible for the loan? What are the things that they have to do to be eligible for an SBA loan?
sure. So, I mean, one of the big things that can blow up a lot of M&A transactions is an earnout clause. SBA does not allow earnouts. So a lot of times that blows up the deal right there, right?
Hmm.
Um, the minimum down payment on an acquisition is 10%. So we have to source that they have that 10%. We can get creative, and up to 7.5% of that can be a seller standby note. So if the seller does a note and there's no payments for 2 years and then it's fully amortizing thereafter, or if the historical cash flow works, they could get interest for those 2 years. Then we are able to finance the other 90% piece. But, these are all negotiations, not
Yeah.
every seller wants to do. But yeah, a lot of it's tweaking the language and making sure, like on a lot of times there'll be a working capital adjustment and you can't have a price change because the price change dictates the minimum down payment requirements.
Hmm.
So we say like have a target amount of working capital, or the banks will do a line of credit in addition to give them working capital. So there's a lot of that kind of stuff that goes back and forth. Um, they have to be for public. They have to have good character. They have to have certain credit, certain liquidity. um, you know, that sort of thing. They have
Cool.
to have, very important, they have to have industry experience or knowledge. So,
All right. You went through a bunch of stuff there. I'm going to go through a couple
yeah,
of them, not all of them, but a couple of them. The first one, you talked about the 10% minimum down payment, but then you talked about options with a seller's note and used some banking terms. Can you make it a little bit more simple for people who may not have gone through a loan process? Like, what is when you say a 2-year wait or a standby with a an amortization? Explain in a little bit more detail
sure.
what that means for people.
Sure. So if the borrower needs to come up with 10%, they're not able to, but they're able to come up with 2.5%. So I've done a ton of these, particularly employees that are buying a business, but they've got 3 kids in college, right? So they don't have that liquidity, but they're the perfect person to buy the company. So the seller will do a note for that 7.5% of the project, which may be the purchase price or maybe the purchase price plus, fees, closing costs. We can roll some stuff in. And if the seller is willing, they do a seller note and they receive no payments. So no principal or interest payments for a period of 2 years. And then they have a loan thereafter, which is fully amortizing, meaning it does not have a big balloon payment. It's not due in year 3 or year 4. It's got, a term of a loan paid over time, and the SBA allows that. That's a workaround, allows that seller note to count as though they put the money in as their equity injection. So it's a pretty cool alternative to the borrower coming up with the full
How
10%.
long do you typically see an SBA loan for, and how long is maybe a typical seller's note that may be used in lieu of a down payment?
Sure. So the maximum loan that an SBA can do when there's no real estate is a 10-year term, 10-year amortization. The seller notes vary dramatically. I mean, you have to keep in mind that we're going to include those seller note payments into our cash flow. So if it's very short, we want the business to be able to afford those payments. So the longer they can get, sometimes they'll just match the SBA's term, um, and sometimes they're shorter. It's whatever you can negotiate, the borrower can negotiate. Yeah.
Do you when you're going through these loans, do you have to go through a valuation process to make sure that the price and the loan value are in alignment? How does that work?
Yep. So, I mean, the first thing we're doing, we're going to calculate the historical business. So you take the 3 years of business federal tax returns and the year-to-date profit and loss and balance sheet, and you take the proposed debt and you apply it backwards. So you go, all right, well, 3 years ago, if you have this loan, does the cash flow work? And we want you to have, your revenue minus your expenses equals your net income. You add back your interest, your depreciation. That's your cash flow. We want you to have $1.20 in cash for every dollar in debt. That's your debt service coverage ratio. Some banks might want you to have $1.25. Certain industries, like a restaurant, they might want you to have $1.50, but 1.20 or 1.25 is the standard, where we want to be able to show that you can repay the loan with a little bit of a cushion. So we're applying that backwards to make sure, that it works. Now, on an SBA deal, you usually require that the last year and the interims work, but we're coming off of years that had COVID years or had supply side issues. So
Mm-hmm.
what I will do a lot of times is I'll collect the 2 prior years to kind of throw the COVID years out the window, right? And sometimes you'll have a company that's in growth mode, so it's not going to work going backwards. But we're able to do things in the SBA world as long as we can demonstrate that there is the opportunity for repayment. So sometimes we'll do financial projections to explain, this is in growth mode, this is going to continue, this is what it looks like. We do that a lot of times on acquisitions. What does the
Mm-hmm.
business look like under the new owner? We
Mm-hmm.
love to see that and have that come from them, and they break it down month by month. So,
So $1.20 per
yep.
dollar, that's a pretty low hurdle. So it's not, you don't have to have show a ton of income to qualify for these. Does
Yep.
that include, if you do a seller note, does that mean it has to be a dollar
Yep.
20 to a dollar, including the seller note and
Correct. Yes, we're
with
looking at
all you do, if you have a line of
all
credit?
of your debt.
Yes.
Correct. And I didn't fully answer your prior question. You asked about the the due diligence. So we do order a third party business valuation on any acquisition deal. And there are a couple companies that do it on behalf of the SBA, and it's not, a quality of earnings. It's not the kind of valuation that's done to stand up in IRS court or divorce court. It's sort of a quick check. It's a $2,500 to $3,000 2 week turnaround valuation where they're looking at the same financials that the bank is looking at, the 3 years of historical, the interims, and they're pulling comps on what, say, an HVAC company has sold for, and they're backing into what's an acceptable multiple. And we're just making sure that we're not grossly overfinancing the business. So I tell everybody that we're going to order this. It's to meet the SBA requirement, but that they should still do their own due diligence,
Mhm.
hire their own CPA or forensic accountant, and still make sure that they're paying the right price, not relying on this. So,
So I've heard a couple things that you've talked about so far. It's about 2 weeks to do a evaluation. You said you can turn stuff around as quickly as 2 weeks, but I've heard that you've had to go through and look at if there's fluctuations within the historical financials. You may have to look at some other data.
yep.
So how early is early enough? Like when's the right time? Like if even though you can do it in 2 weeks, they can't come to you and say, okay, 2 weeks we're going to close and give me my loan. When
No.
should they really come in and talk to you?
Yeah, I mean, as soon as they're thinking of making the offer, I would say, because a lot of times people will come in before they make the LOI. Sometimes the brokers will send something over and just have us kind of look at it and do a quick, what do you think? Sort of pre-screen it for SBA. Um,
Hmm.
and I love that. I mean, I love looking at it and being familiar with it early on. And maybe point out something, we're going to need documentation of this, we're going to need support of this. Like anytime there's seller add backs, the
Hmm.
brokers are always, you have your seller discretionary income, right, which is the bottom line with all of the add backs that the seller gets.
Hmm.
Sometimes we want documentation for that. If there's family members, for example, who are taking salaries, we want to get their W-2s. We want to be able to support that these are
And
true.
prove they're not really working there either.
Well, yeah, I mean that's often the case, right, on a family business. But yeah, so I love getting in early, telling people, and also telling them what the expectation is, because a lot of these deals they're service businesses, so they're light on collateral. And so we're going to look to personal assets. And I want them to have a discussion with the spouse that the house is going to need to be pledged and that the spouse would have to do a limited guarantee limited to their interest in the house. I like to know, I love people to know if it's a sole single person buying, that we're probably going to require keyman life insurance because that can take a long time to obtain. So I want them to start these things early in the process so that we're not holding them up to get to closing. So yeah, I love the earlier we can get in and talk about things, I think the smoother we can make it. We've closed plenty of things in 45 to 60 days, but um, yeah, it's great to get in early and not have it be a fire drill.
So this makes sense, like because typically what I've seen is due diligence, if it's really fast, might be 45 or no 60. But typically it's more like 90 days
Correct.
because it's not because anyone's slow. You got to coordinate a bunch of different people.
Yep.
So if they're involved, if you're involved, that whether the broker on the sell side's introducing the concept so that you're available to help a buyer, or the buyer themselves is reaching out and saying, hey, I'm looking to acquire. I mean, if they're talking to you 15 to 30 days before they're going to make an offer and put it into an LOI, and then they have the 90 days diligence. That's more than enough time to get the stuff working.
Plenty of time. Yeah. The only stuff that takes longer than the 90-day period is I do a lot of rest homes, and the licensing process takes a long time, or liquor licenses. But a lot of times
Hmm.
we'll do the liquor license as a post condition where they start it before. But yeah,
You mentioned something too, and this is big for me. Well, two things. Quick question first. When you said that you got a quick valuation around it's, and again, I do valuations similar to what you're saying is I don't do stuff for divorce court or for litigation and state tax returns.
yep.
But and you talked about you want to make sure comfortable with the multiples. What are the multiples you're looking at? Are you looking at EBITDA, revenue, sellers discretionary earnings? Like what's a typical valuation metric that you're using? Is it which one of those line items?
I mean, we're outsourcing the valuation part. So
But, but
yeah,
what do they care
multiple of
more
earnings,
about?
multiple of earnings.
So the SDE or the EBITDA?
Uh, Honestly, can I be honest? I go to the cheat sheet like an appraisal where I go, this is the value.
Okay.
We don't look any further unless it doesn't come in where it's supposed to.
Okay. Um, the other thing you mentioned is that you typically use the returns to figure out the.
We
So
do.
this is interesting because how do you deal with this situation? We're going to talk about I think part of it in a second, but a lot of people do not like paying taxes, so they find creative ways to reduce their taxes, which means their tax returns show less income,
Yep.
which then is now going to impact their ability to get a loan because you're using the tax return.
Right.
Like
It's a
what if
fine line between paying taxes and being bankable. I mean, we are a federal loan program, so we are using the federal tax returns.
yeah,
And, it you have to demonstrate the ability to repay. So, there are certain things that will be added back and there's always one-time things, but yeah, the numbers need to prove out. Like I said, on some occasions you can do projection based, but it it boils down to does it does it illustrate the ability to repay
right.
or not? So yes, somebody can make themselves not bankable by
By trying to save a little bit
by
on
padding.
taxes.
Yeah, yeah, yeah.
Yes. So that I mean, this is something I've talked to people all the time. They try to like say, "Oh, I saved $100,000 on," um, and I put $100,000 of expenses that were questionably related to the business,
Right.
or maybe they just definitely weren't related to the business.
Well,
Say
that
so,
can affect their valuation too, right? I
right,
mean, if somebody is using the business as a checkbook, the value of their business is going to come out lower. So
correct. I mean, that's the big issue I see is that like they'll save like $100,000 run through that saves them 30,000 in taxes, but if the multiple's four times 100 is 400,000, so they saved 30,000 in taxes,
yeah.
but they lost 400,000 in value and potentially the ability not to get a loan.
The same thing happened, Greg, during PPP, where people were doing all kinds of weird things to pay themselves or and then they weren't eligible, and so they missed out. I mean, you can't have it both ways.
Right.
If you're a business owner and you want to be bankable, it's the same thing. People do cash basis versus accrual basis. You're not stopping the tax, you're just deferring it, but it can affect whether you get the loan or not.
Yeah. No, and this is I'm glad you're saying because I say it a lot,
Yep.
but I don't really have the power of the pen of writing authorizing cash to go to someone. I help facilitate the transaction. Having someone who says, "Okay, you're not going to get the money because you made decisions to reduce your taxable income, whether it appropriately or inappropriately, most
Yeah.
likely inappropriately. That
Yeah.
has big impacts, and usually the loss of the ability to sell your business and to get the loan and to get the value for the business far outweighs what you saved in taxes.
By far. I had somebody in it was two business owners, and one partner had a ton of real estate investments, but every piece of real estate he wrote off all kinds of stuff, and rental, like marketing fees, that kind of thing. And when it came time to do the global cash flow, like, you would think he would get the rental income, but there was such an offset in his write-offs that, like, his DTI his debt to income was really high, and like it made him hard to bank.
Yeah.
So
And
yeah,
this is the big lesson I want people to hear. Like one of the big things I want, if I take anything away from what you and I are talking about, is showing income is a good thing. No one pay as little as taxes you possibly can, but do it legally
right.
and following the laws. Like I don't want to pay any more than I have to, but I make sure that I'm following the law as written and maximizing it as written because
Well, a
I don't.
lot of times people at the end of the year, like for example, I just had somebody who they made a ton of money, and so they decided to buy a piece of equipment, and then they took the accelerated depreciation. So when I'm doing my cash flow, even though they lowered their taxes because they had that big expense, but they had the huge depreciation, which is an add back to cash
Mhm.
flow. So, they're still bankable, right?
Right.
I mean, so a lot of people do it that way, right? Rather than because when banks are doing when you're taking your money, all the money out of the business as a distribution, banks will back out distributions, right? And out of the cash flow calculation. And so that can hurt too. I mean, we want you to leave money in to reinvest in the business. We want the business to be bankable. That is an important lesson.
So
So,
you talked about earlier when you're converting from the tax return to what your actual cash flow might be that you're analyzing. You mentioned the term add backs, and all of us in the brokerage space, M&A space, add backs are fact of life.
yeah,
Um, but I think there's a misnomer. At least I hear people. At least when I hear people, they talk to their friends at the golf course and sold their business. Oh, you get to add this back, add that back, add what all these things back. But I have to point out to people, just because you put it as an add back doesn't mean the other side will accept it.
right,
And more importantly, if you're going to need a loan, will the bank say, "Yeah, I that's a valid add back. We'll accept it as well." How
right,
often do add backs get kicked out?
right. So, I mean, a lot of times the seller discretionary income has, the owner salary, which makes sense, right? But we're going to minus out what the new owner salary is going to be.
Right.
Um, Certainly add back any family members who were taking salary that weren't working there. Um, Interest and depreciation, that's normal. But then, the owner car. Well, the new owner is probably going to have a car. The owner's cell phone. The new owner is going to have a cell phone. Owner pension. The new owner is going to have a pension. So a lot of that stuff I just don't add back because
Mhm.
unless you have an operator who owns and has taken their salary through another affiliate and getting all these benefits, the new person is going to want those same benefits. So, just like my bank adds in my life insurance, the cost of my disability, whatever,
Yeah.
into my salary,
Yeah.
I'm not taking that home.
Right.
So, yeah, I think that it's good to know what the package is, but yes, if we're relying on your cell phone to make cash flow, we've got a problem.
Right.
So, yeah, I'm willing to add back anything that's legit, like the additional family members or an excess salary or they're overpaying rent or something like that. Anything I can legitimize or one-time expense that is legitimate, happy to add that into cash flow. And also, like, sometimes you have people who have never written off inventory and suddenly they do a big inventory write-off right before because they've spoken to someone like you and they're cleaning up the books before the sale. And I'll go in and I'll say, all right, if we took that and we really did it over 3 years, like this is what it looked like.
Mhm.
Or like I had somebody that did a big equipment sale and it was the practice of their business to sell off equipment. It was a landscaper. And so I went back 5 years because I was doing the pre-COVID years and I just averaged out and I said, instead of discounting this whole big lump sum, let's say what it will be, because this is going to be a continuing practice. And you kind of make sense of it, right? And average it out over a couple of years. So you can, I mean, if you understand what it is, you can make sense of it. And particularly with the big write-off, the big
Mhm.
inventory write-off, obsolete inventory or something like that.
Um, you mentioned earlier about no earnouts
Yeah.
with the SBA lending, and this sometimes comes an issue where because in a space where it's all cash or it's a conventional lending, if the two parties are arguing over like I think your business is worth 5 million, the other side says no, I think it's worth 6,
Yeah.
and they say, well, all right, fine, I'll give you the 5 and I'll give you the opportunity to get the million.
Yep.
And if the buyer is going to be using an SBA loan, well, that's off the table. How do you see the buyer and seller negotiating that gap when you're not allowed to have an earner? Like, what are some of the, because I don't do a ton of SBA
Yeah.
clients. I think the last time I did an SBA transaction was probably 6, 7 years ago. So this is why whenever I have an issue or it might be SBA, this is why I call Kathy, because I'm out of practice. Um, so
And
how
the
do you,
rules change constantly.
yeah, yeah, and I know it. Yeah, the last time I had to do it, it's way different now because you gave a whole dissertation at a meeting I was at on all the changes. I'm like, oh, that's not
Yeah, I want to touch on a couple of those today. Yeah.
absolutely. So
This
how
is
do you
exciting.
navigate that where there's a slight difference in valuation on both sides? in a conventional situation, you say there's an earnout and this is how we're going to close the gap. How do they do that when it's in an SBA situation? What are the things they can do?
Yeah, I mean, it's a real problem because you cannot have an earnout. I mean, we're not interested in the seller getting there. We're interested what's it worth today?
Hmm.
What's the value going to come in at today to justify our financing? And that's the price, not what they're going to get in the next year or forward, because there's no mechanism in allowed that would allow the seller to get additional money post closing. And so what the reverse of that is allowed, which is a clawback. So in like I do a ton of CPA practices, sort of one man CPA practices being rolled up, and now those kind of businesses, you're worried about a mass exodus of clients, so you can have a clawback to protect the buyer and the borrower and the bank and the SBA from exodus of all clients or exodus of one main client. And so we can do a clawback mechanism. So if that additional million you're talking about, if the business could value for that now, the buyer could have a clawback that said, if revenues don't do this, then the seller would rebate that, and oftentimes we'll do that with a seller note. So there'll be a forgiveness component.
Yep.
Seller note. That's the cleanest way to do it. Otherwise, we can't. The money gets withheld, and it doesn't get fully dispersed until the clawback period happens.
So I'm going to simplify it for me,
Yep.
and hopefully it's simple for other people because I have a very simple brain. When I negotiate deals, I have the KISS principle: keep it really simple.
Okay.
Actually, that's a KRIS. Keep it simple. Um, So in a conventional loan, or if you're dealing with a buyer, a cash buyer, it might be okay. We agree it's at least 5 million. If it's worth six, you'd have the $1 million earnout. In the SBA situation, say instead of saying five and you can earn the six, you might say, okay, we'll do six, but there's going to be clawbacks to get back to five. Or you'd say we'll do six plus the seller's note, and we'll make the seller's note forgivable. If you don't hit these targets, the note gets forgiven.
But it's real. But again, it's protection for the buyer, not the seller. So
Correct. But
if
so
it doesn't do this revenue number, then it rebates the buyer, not.
right.
Yeah.
So the seller, but so in most situations, the buyer keeps in a not most situations, in a conventional situation, the buyer sets a lower number and will pay more later. In this situation, you have to set the price higher with the opportunity to pull it back. So you can get there,
If
but you
the
have to
value
start in a
comes in
different
there, yes.
direction.
Another alternative, and this is one of the new rules that SBA came out with, is you can have a partial buyout, which was never allowed historically. Historically, you always needed 100% transfer of ownership in an acquisition.
Okay.
Now you could have a partial buyout situation where the buyer buys, say, 81% of the business, the seller stays on, and then the seller's able to, get some kind of, because they're an owner.
Hmm.
And if, as long as they're 20%, uh, or sorry, less than 20% owner, they don't have to guarantee the loan. And that's an alternative that was never available to us before, which is very exciting. Because we didn't have any opportunity if you had somebody that wanted to stay in. Other people wanted to exit. There was nothing we could do for them, and now we can. So that's
Oh, that's yeah, because that was I remember the back when I was doing this 7 years, 6, 7 years ago, that they wanted the the owner to stay on for multiple years for transition, and you couldn't do that back
you
then.
can't. Yeah. So if you have 100% transfer of ownership, the seller can transition you for up to 12 months, but they must be gone. They can't be a consultant, an employee, anything beyond that 12 months on 100% transfer of ownership. But now we have, yeah, this new tool in our bucket, so they can stay on and ride it into retirement as a partial owner. So that's pretty cool.
Could they be a 1% owner so they could stay on to provide for longer transition?
Yeah.
So
Yep.
this creates a lot more flexibility than it used to be. It's a lot more rigid.
Huge, huge. And one other thing that was huge change. So there's a rule called the affiliation rule. So if you owned 10 hotels and 10 restaurants and 10 rest homes, we used to have to look at those 30 businesses aggregately to say, do you already have $5 million in SBA money? Are you too big for SBA? And now we only have to look within the same industry. So, you can have those hotels, you can have those restaurants, but I can do rest homes and look at just that industry code. So that's a huge difference too, and allows us to do more for more people.
And I think that came up. It did not end up working out for the buyer you were helping, but
Yeah.
we had a manufacturer
Yes.
I was representing, and one of your clients was interested,
Yep.
but they were up against limit on other acquisitions, and you were able to say, okay, this industry is completely different. We can
Yep.
help you make
Yep.
finance the offer you want to make.
So I had exhausted his $5 million. I did about $5 million for an acquisition 2 years ago, and then he wanted to buy another company, and the NACE code was different. They both started with a three manufacturing, but the second and third were different. Therefore, he gets another $5 million. Interesting enough, while we're on this topic, so I have somebody right now that has a certain industry, bought a business a couple of years ago. Now he's buying the same exact business, same exact industry code, exact 6 digits. And I'm able to do, we call it an expansion now, and there's no 10% down payment requirement. So I can do 100% financing because it's an expansion. So that was
Ah,
cool. Now, I didn't finance, he paid cash for the first one, so he didn't have any SBA money. So we're not bumping up against the limit. We're starting out with a fresh 5 million. So that's pretty cool. And that's actually a larger deal. So that's an $8 million deal. I'm going to do 4.5 million term, $500,000 line of credit. And then I've got a mezz fund coming in and doing the 3.5 million
what's
to
a mez fund?
a mezzanine fund. So they're going to be a participant. Uh, this happens to be Mass Cap, which is a insurance fund, and they will go behind the bank, so junior in secondary position, and there's no personal guarantee, and so they have different criteria certainly than the SBA does. But the alternative was the bank could do the 8 million, but then we would have a big collateral airball in the second piece, which would make it harder to finance. And this takes it out of that box. So now if they do a second one, maybe I could do something else for them and keep it in my world. So
So
um,
and you use another term that I hear a lot, but a lot of people don't know what it means. What's a collateral airball?
So most businesses nowadays are service businesses. So they're very light on the balance sheet. They don't have a lot of assets.
Mhm.
Gone are the days when you had manufacturers with a ton of equipment. So most businesses have a table and chair and some obsolete computers, and that's our collateral. And the
Yeah.
value is really the name, the brand, the customer list, and that's it. Intangible sort of assets. And so it makes it hard. Most banks, if they're doing $1 million loan, they want $1 million in collateral on a conventional deal.
Hmm.
The SBA, the whole purpose of the SBA is to make up for a collateral shortfall. So, if I do $1 million loan with tables and chairs, I do a lien on the business assets, and I might look to personal assets, but I'm going to get a 75% guarantee from the US government. And, if that company is an exporter, I'm going to get a 90% guarantee from the US government. So it makes it a lot easier to finance, a lot more palatable for underwriting, reduces our risk. That's the whole point of SBA. And the SBA, the borrower gets a smaller down payment, a longer term, and they get the loan where they mightn't have otherwise. So it's pretty cool when it fits in the box. It really is it's a game changer.
From the changes too, it is a lot more flexible. It's still a little bit more rigid than conventional, or if you're using your own cash, but it does create a lot more opportunities, a lot more ways to solve problems that normally come up during a negotiation.
I mean, the folks that are in like my networking group, my competitors, they're doing 50% financing. And they'll do no personal guarantee or whatever, but you're coming up with 50%. So, I'm 90%. There's a
Hmm.
huge difference there.
Hmm.
So, you got to weigh all of that. Like I said, a lot of the people I'm financing, they've got 3 kids in college and they're scraping up the 2.5% or
Yeah.
whatever it is to get there. So it really it helps out a lot of people that wouldn't be able to buy otherwise.
I'm gonna go back a couple sentences ago, or minutes ago. You talked about how if it's a different industry code, you can create a new pool of money to lend. So you talked about the first digit, like three. For anyone who doesn't know, a NAICS code is that's how you classify industries for whether for your tax return or for lending. A NAICS code is a standard code, 6 digits by that's set out by the U.S. Census. Um, and it basically puts every single business into a code, whether you're a manufacturer or you're a retailer, you're a wholesaler, you're a service company, you're a gym, you're a restaurant. Like in manufacturers, it will also break it down to you manufacturing wood materials, are you manufacturing textiles, are you manufacturing metals, are you manufacturing plastics. Um, so that's what an NAICS code is. So how in the 6 digits will allow you to have a lot of different variations within manufacturing, a lot of different variations within retail, a lot of variations within service. Um, how different do the 6 codes have to be? Like you said, the first one was the same, the next two were different. How many have to be different?
So we're looking for that particular thing. We're looking at the first three. So,
If the first three are the same, you're the same industry, but if the first three are different, so if it's 322
yep,
and
yep.
323, you can make a loan. But if it's 323, 323, and
You know, I honestly don't know if it's 322 and 323 because, but that could be a very similar business. In mine, the first digit was the same, which meant manufacturing, but they were manufacturing different things. So
yeah,
I emailed SBA, sort of a CYA email to put in
yeah,
my file that I could do it with the three because I was worried initially that the three would be a conflict, but yeah, so I got permission. I don't know, you'd have to read it, and you'd also have to understand because sometimes when the CPAs are doing the NACE code, a lot of times actually, the IRS one is different than the one that because we're getting conflicts all the time when we're trying to put them in the SBA system. It comes up as invalid code because they use a different list, or maybe the list changes. I don't know, but so you'd really have to understand like they're manufacturing something different than this one because what I don't want to do is do it incorrectly and risk losing my guarantee. So
right,
a lot of due diligence. A lot of these rules are new rules, and a lot of them, it's government, so it's somewhat vague in the the instruction, and so I spend a lot of time kind of communicating with SBA and interpreting to try and make sure I'm keeping that guarantee because we wouldn't be doing 5 million with tables and chairs without the 75%. So I got to make sure I can keep the 75%.
you mentioned earlier about industry experience when you're doing the SBA. So how do you guys determine the industry experience? Because like I don't know if you're seeing it, but I get a lot of people that are it's this entrepreneurship through acquisition. It's a lot of people come out of the MBA world, or they're leaving private equity and saying,
Yeah.
I'm tired of writing checks for other people. I want to run a business. How do you go through that process and say what is relevant industry experience to be able to qualify?
Yeah, I mean, if somebody, I mean, skills transfer, right? If you've been running companies, valuing companies, buying companies on behalf of the PE firm, there's certainly you don't have to be doing the exact same thing, have the exact same title. But I think that there are specific banks that might be interested in doing kids straight out of school that have the education but don't have the experience. That would be very difficult for me to do. We want real life work experience and familiarity with either transferable skills or familiarity with the specific industry or past ownership experience. I can't tell you how many calls I get, and particularly for some reason people romanticize the restaurant world where they want to open a restaurant and they've barely worked in a restaurant, and that's just it's not going to happen.
Right.
But there's plenty of people that worked in some aspect of manufacturing, their engineering degrees. I mean, a lot of the ones I mentioned earlier I'm doing are employees who have worked for a company. I mean, we love, love, love those because they already get the culture, they already fit. But yeah, it does not have to be an exact title copy, but I mean, if somebody's been in manufacturing or doing accounting, financial of manufacturing, whatever, there's an understanding of it that, and I usually have them write up a mini business plan, and rather than me trying to extrapolate from a resume, I have them spell out why they are, they've managed a similar size budget, they've managed similar size teams, they've, that kind of a thing.
Cool. So, and you mentioned something I was going to ask you, but you kind of led right into it. It's like this makes it a really good tool, like for a sale to the management team. Like, because a lot of times I've talked to people and I say, I want my management team to buy this business, and two things that could become an issue. One is even though you probably pay them a good salary, they're not saving it all so they can eventually buy the company. They're
Right,
spending it on their house, they're spending it on their kids' college, they're spending it on all kinds of things. It's
yeah,
not accumulating to put as a down payment.
right.
This is one way to get it. Plus, you get that industry experience hurdle. So that's pretty interesting.
Love that. I've
How
done so
many?
many of those.
To
But
me, that's
I love that scenario. I mean, the
yeah,
employee.
because that's the biggest thing. Then the second part. How do you ever see this or deal with this? Is okay, they get the guarantee from the SBA, but now their house is also up for sale. You mentioned a little bit earlier.
Oh, yeah.
To me, that's the second issue I see with the management sales. One is getting the financing, and the SBA loan, I think, help bridges that gap. But you're still putting a personal guarantee on the on the loan.
Correct.
How difficult have you seen those conversations when dealing with your buyer? Like, okay, yeah, this is what you have to put up to, and what you have to do to for us to be comfortable making this loan.
Yeah, I mean, sometimes it's a deal breaker for people and they just come in as a minority partner. And if they're below the 20%, they're not pledging. Somebody has to pledge. You always have to have a guarantor, but you don't have to have all of the management team be guarantors. I think what is really hard is when one person has all the assets and the other people have nothing. Everybody's renting except for the one guy who's got three houses and then he's on the hook. But that's a negotiation between them. Maybe he gets higher compensation. Maybe he gets higher percentage of ownership because he's more at risk. So I've had that happen. I had three women that were buying a hair salon and only one was pledging, and they worked out, something like that amongst themselves to
Very
come to
cool.
an agreement of what was fair for
Well, and
one
these
person.
are the types of scenarios I like talking about because everybody thinks like, oh, I'm going to sell it to my management team and it's going to be this easy. I'm like, it's never that easy because there's so many
Yeah.
different dynamics and
Yep.
hearing different ways to solve problems. Like that's where I would actually what I think you probably think the same ways. I I love when it's straightforward because it's easy, but I also like being able to solve problems and help people achieve their goals
Yep.
because and it's never really a straight line. We never really get a straight short putt that's like 3 feet. We're going to knock it in.
I
We always have
very
these twisters that we have to navigate to get into the
I
hole.
don't remember the last vanilla deal I've had.
Yeah.
I long for one, but yeah, no, usually there's some hair on them. That's why they're SBA, You either have an off year or somebody had a distant bankruptcy due to an illness or a divorce, or, there's usually a little bit of hair on it. Or, like the down payment is, we're scraping together a way to get it. I mean, I had somebody, it was the 2.5% down payment was a gift from family, and then the seller did the 7.5%. So yeah, I mean, we can, but the person had worked for the company for 15 years, so we wanted that person as the buyer, Um,
I'm gonna put you on the spot. We've like about 5, 10 minutes left.
yep.
I would put you on the spot. What is the one transaction that you're the most proud of because it took the most creativity and you really that was psyched that you were able to get that deal done?
Yep. Okay. So I had one very recently that had a huge customer concentration. So it was like a 50% customer concentration. And
What's
so
customer concentration mean?
customer concentration means, you know, uh, well, in this instance, 50% of their customer base, 50% of their revenue came from one customer.
And
So
that's not good, right?
no, normally, banks get very, very nervous over, anything 15% or more. And so, your first questions are, how long has that customer been with you? Are they under contract?
Mhm.
Um, and also, if you delve a little deeper, like say it was Raytheon, for example, was the customer, you want to say, well, all right, is it one department in Raytheon or is it 200 different departments? Because maybe a new department head comes in and says, we're going to use my guy, but it's unlikely that you're going to lose it from every single department, right? And
Mhm.
so you try and mitigate your, situation with that, or you do a clawback where there's a seller note component and you say, all right, well, there's going to be a clawback if we lose this big relationship. And
Mhm.
so with all of those things, I was able to mitigate. And I think that the broker had, called around to other banks and they were just like, oh, 50%, nope, 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 nope. And so it was creative financing. In addition, they were an exporter. So I went through the International Trade Loan Program, which is under the 7A umbrella, one of the SBAs. And when I do an export loan, I get a 90% guarantee. So my risk was greatly reduced
Mhm.
between the clawback mechanism of the seller note with forgiveness and between that. So I was quite, that was a nice one. Um, Felt good. I got a new broker relationship out of it because they were so pleased
Mhm.
with the recommendations. So
Everyone loves it when you can we work with someone else who's willing to help solve the problem, not just put it back on you. So, and I know that's your MO. You love to solve problems, and I think that's why people love working with you.
thank you. Well, I try.
All right, the last one. So hopefully this is a softball for you. What can people do to make it easy to work with you?
Yeah. So, one thing that just is very, very, very challenging because you have so many deals coming at you in partial packages, is for the person to be organized. And when they send you a package, like I send out a checklist, and people will send, five things on the checklist, and then they're like, are you ready? Or am I approved? You go, well, I sent you a list of 15 things.
Yeah.
If people are organized and they send, like I asked them, send me, because I have so much stuff coming in, I'm just dragging it into a file until I've got a complete package. You know, Tell me when I've got a complete package, and have it be complete. Fill out the paperwork. Don't skip questions. Don't, miss
Hmm.
things that were asked for. Because we do need a complete package. And, when it's being submitted, it gets kicked out. It doesn't get accepted into the queue if we don't have a complete package. So that's one thing. And be prepared. If you're selling your business, you can't be on extension until October. You need to file your taxes because we don't like to lend on interims, and we
Hmm.
want to we want to see what those numbers are, and we
Hmm.
don't want to approve it and then have it be a pre-closing condition, and then there's a change between the interims and the tax returns, which can happen, as you
Hmm.
know.
Yeah.
People are doing their own interims. So yeah, I mean, if you're a seller, be prepared to be responsive. Nothing kills a deal worse than time.
Hmm.
Things drag on or change. So and I just would love to mention one more thing. So I think I talked briefly, when you're buying something within the same industry code, there's not necessarily a down payment, but also with that partial buy-in, if the debt to worth is less than 9 to 1, so there's no debt, pre-closing, there's not a requirement for a down payment there either. So that could help out in that employee situation where they don't, the seller maybe stays on
Hmm.
the experience, and the management team doesn't have the down payment. So anyway, one other thing I'll just mention is, it's very important to understand, because I think it's a point of frustration for people, is there are SBA rules and then there are bank rules. So SBA will allow you to do, in certain instances, 100% financing, or with that 2.5% in, but not every bank is going to be comfortable with that. So that's a huge point of frustration for people. Or some banks will do, $1 million with tables and chairs and a
Yeah.
guarantee, but they won't do 5 million. And so you really have to get to a true SBA lender that's comfortable doing what SBA allows us to do. So I think that, alleviates the frustration if you get to the right place.
Awesome. Well, thank you for all this information. I'm sure we left a lot of information on the table that still needs to be discussed, but you know what? If there are questions that weren't answered, I'm sure you can follow up with Kathy, how could someone get a hold of you if they have more questions about this process?
Sure. So my email is Kelly, KATKELLY, at websterbank.com. And my cell phone, which is my business line, is 617-416-6567.
Kat, thank you so much for being a guest and providing all this information. And I'm sure you'll be getting some follow-up calls because you put a lot of information out there. There's a lot to digest, and as we have all seen and heard, there's lots of different ways to get to the end line, and it just takes a little bit of planning and creativity to get there. But thanks again for your time,
Thank
and I
thank
look forward to
you.
seeing you at our networking events coming up soon.
All right, great. Thanks, Greg.